Hello again, Chris Pacella, CFA, financial consultant with Lancz Associates. Already this year, we've been through the shortest bear market in U.S. history and recovered to set new all-time highs on the S&P 500 and the NASDAQ composite, while interest rates were plunging to new lows. The NASDAQ then went through its quickest correction in history, losing over 10% of its value in just 3 days. We are definitely living through historical times. We expect risk management to remain critical going forward, and with interest rates so low, many investors have been chasing stocks to fund their retirement. One way you can protect your portfolio while still participating in market upside is with stop losses. Properly utilized, stop losses can reduce risk while eliminating significant downside during market sell-offs. They can also reduce your exposure to concentrated positions, especially if you have large positions in high flyers. A stop loss is technically a limit sell order that goes in under the current price of a stock or exchange traded fund in order to stop the loss of a further downside. Then, if the stock drops below that level you set, it becomes a market order. Now, you may not always get the exact price you want. It is possible for the stock to gap down, but the idea here is to protect against a significant decline, similar to what we saw earlier this year. But if stocks move higher, you can still participate and may even raise your old stop levels to lock in those higher gains. This is what we call a trailing stop loss. On the buy side, it's actually smart to do the exact opposite, placing a buy limit order below the current price of the stock to accumulate positions into panic selling. These are two strategies to help manage your investments in these historical times of unprecedented volatility. There are other ways to protect your portfolio, including using option strategies, and we'll review some of these the next time we meet.
Hello, I'm Kirsten Wittenberg with Lancz Associates. Today's Minute for Millennials will be about the top 3 mistakes that millennials make when planning for the future. For starters, millennials tend to spend at a rate faster than what they earn. By not saving any money in general, what are you going to do when there's an emergency? If you're spending it all, what money are you going to have for retirement? The second mistake millennials often make is the mistake of not maxing out on their 401k. If your employer is willing to match whatever you put into your 401k by a certain percentage, then it is crucial to take advantage of that. It's an instant return on investment. Finally, millennials have the tendency of letting their credit cards debt pile up because they're only required to pay a minimum each month. With credit card interest rates being in the double digits, the interest on the cards really add up. Interest rates are at an all-time low, so you should be borrowing from somewhere with a lower interest rate. Until next time, please feel free to share this video with anyone that you feel can benefit from this information.